Hey everyone, welcome back to our quick video series. And I am extremely sorry for everyone that I was not able to upload the videos in the past week. And continuing our series, today we are discussing chapter 4 of CA Foundation Business Economics, price determination in various market, and in which we will discussing unit 2, that is determination of prices. And firstly, today is Independence Day, and I wish everyone a happy and prosperous Independence Day. So let's get back to video. So we'll be discussing about the various determination of price. So here is introduction. Price determination is a fundamental concept in economics where the price of goods or service is set by the interaction of demand and supply. It means that the demand and supply forces are responsible for setting a price. The point where these two forces meet is called the market equilibrium. Understanding these concepts help us to comprehend why price fluctuate and how market reach stability. So imagine you are at a local vegetable market in India. One day you find that the price of tomatoes has skyrocketed while the price of potatoes has plummeted, means gone down. These changes aren't random, they are driven by the forces of demand and supply. So let's explore how these forces work together to determine prices. Determination of prices. The equilibrium price is where the quantity of goods demanded by consumer equals the quantity supplied by producer, means demand equals to supply. At this point the market is balanced. Example, let's assume a small market where the following data represents the demand and supply for a product. So demand, say for a product X, at demand at rupees 50 consumers are willing to buy 100 units, and at rupees 40 they want 150 units, and similarly at rupees 30 they wants 200 unit. Similarly, on the supply side, producers are willing to supply 100 units at rupees 30, 150 units at 40, and 200 units at 50. So here is a table based on our data. We have price, quantity demanded, and quantity supplied. That at rupees 30 we have quantity demand of 200 units, and quantity supplied or quantity available are only 100 units. Similarly, at rupees 40 we have quantity demand that demanded 150 units, and quantity supplied also 150 units. And in last case, at rupees 50 we have demand for 100 units, but the supply is excess of 200 units. And like earlier video, I have visualized this in a graphical way. So here we have this price 30, 40, 50, and this is the equilibrium price where price demand equals to supply, this center point. At rupees 40 demand equals to supply, making rupees 40 as the equilibrium price, means the center price. Then comes changes in demand and supply. Changes in demand and supply shifts the equilibrium price, means there is a shift. So we have created some cases for explaining the theory. First one is there is increase in demand. So when demand increases, the demand curve shifts to the right, leading to a higher price. Example, suppose during a festival the demand for sweet increases. The demand data could be looked as above. So here we have price data, original demand data, and new demand data. So the price is similar to about 30, 40, 50, and we have original demand, that regular demand is 200 units, 150 units, and 100 units. But due to some festive season the demand has rise, and we have new demand of 300 units at rupees 30, 250 units at 40, and 200 units at rupees 50. So we have visualized it similar to above. So you can see this orange is demand curve, and we have keep the original as it is. And since the price has been the demand has been increased, you will see there will be shift from equilibrium price of rupees 40 to 50, considering all other things as same. Then comes second situation where if the demand decreases, the demand curve shifts to the left resulting in a lower price. We can continue with the similar case, but here the demand will, instead of rising, will fall. So after the festive season, the demand for sweets drop. The new data might look like this. So we have price, original demand as earlier, and a new demand which is a reduced one from 200 to 150, from 150 to 100, and from 100 to 50. So we have three cases at three different prices. And similarly, you can see a graph similar to earlier one, but there is a downward shift. So from the equilibrium price of 40, I think there is some error in the graph, but I will try to correct it. The price will drop here at 30 because there will be change in demand. Third comes increase in supply. When supply increases, the supply curve shifts to the right, lowering the price. It will be a case similar, but the supply will be more. A bumper crop increases the supply of wheat. So we have similar data: price, original supply, and revised or new supply. So the demand will be the same, but supply quantity will be increased. So in first case, it will rise from 100 to 150. In second case to 200, and third case to 250. So the equilibrium price will decrease from 40 to 30 due to increased supply. So there will be shift. Then comes decrease in supply. So you will see the green one is the original one and the red one is the changed one. Similarly, we have a fourth case where we will be having reduced supplies compared to the original one. And here also you can see one on the upper side and second curve is on the lower side. So green is the original one, new supply will be on the lower side. Now we have a fifth case where both demand and supply increased and the demand curve shifts to rightward. The effect on price depends on the magnitude of these shifts. So we have an example where we will be continuing with the same data where price equals to rupees 30, 40, 50 in three cases. Original demand is 200, 150 and 100, while the new demand is 250, 200, 150, and similarly original supply is 100, 150, 200 and the new supply will be 150, 200 and 250. So the graph will look like this: original supply, original demand, revised supply. So there will be shift. Actually the data is visualized little bit incorrect. The price should be on the y axis and quantity should be on the x axis. I will try to correct it and upload the notes on the YouTube video. And similarly there is a sixth case where simultaneously there will be decrease in demand and supply. When both demand and supply decreases, the demand and supply curve shifts to leftward. The effect on price depends on the relative shifts. So we have a similar example, but there will be a decrease in both quantity. So you may see that both are looking a little bit same, but this is the new one, new equilibrium point, while in first case it was on the upper side. So these are the 6 cases. Kindly bear with me for the graphical error. I will try to correct it and upload it on the YouTube video description. Now comes MG extras. So this is like every other video, we will be having some examples or activity which will help you to understand the concepts taught in this video better. So first case is visit a local fruits market, track the prices of seasonal fruits and observe how they change based on the availability and consumer demand. And we have one more activity for you, that is analyze recent news reports on commodity prices like petroleum, onion or gold. Discuss whether the price changes were due to shift in demand, supply or both. And now comes to conclusion, that is understanding price determination in different market structures gives us insights into how market function and why price fluctuate. This helps us to grasp better the dynamic interplay between demand and supply that shapes our economy. Thank you, keep learning, keep growing, and bye bye.